Hi, everybody, and welcome to our second quarterly investor call of 2022. Thank you for joining us today. We'll be hosting a Q&A session at the end of this call, so please use the question or chat box to submit questions to Justin, Peter, and Dominic throughout the presentation. We will address all questions at the end of this call. This call will be recorded and will be available for replay by visiting our website and clicking on the Resources tab and then clicking on the Quarterly Investor Call. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe Stevens Advisory website, located under the Resources tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thank you, Carly. Good afternoon, and thank you all for joining us today. The economic items we're going to address today are inflation and the war in Ukraine. We'll get into the exposure we have to the war in our portfolio. I'll also talk about the rising cost environment that we're in today and the market implications on the Federal Reserve rate hikes that are expected throughout the year. Next, Dominic will spend some time on our investment process and discuss how our portfolio is different and designed to win in an inflationary environment. That will include the importance of dividends and research and development, both which are capital allocation techniques. And finally, we'll address your questions at the end of the call. As Carly said, you can type your questions into the chat box at any time during our remarks, and we will address those questions in the order that they're received. The markets reacted negatively during the first quarter to the shocking news of Russia invading Ukraine on February 24th. Investors naturally reacted to this terrible news and the anticipated sanctions that were expected on Russia. The following weeks, we saw the S&P 500 lose about 13% off its highest closing value, although we've seen about half of that recovered through the end of the first quarter. Our O'Keefe Stevens Advisory portfolio fared better than the S&P 500, namely due to our limited exposure to the mega cap technology, communications, and consumer discretionary sectors. These sectors have the largest representation in the S&P 500, and each was down approximately 10% for the quarter. Furthermore, our larger allocation to energy and financials actually helped our performance. But the real question here is, what impact will this war have on your portfolio? And the quick answer to that is there is no direct exposure to Russia or Ukraine in your portfolio. The real impact to your portfolio will be experienced as Russian sanctions and supply chain disruptions in Europe will have some indirect impact on some, but not all of our holdings. Our primary exposure to Europe is in the two financial companies we own, Bank of Ireland and Investor AB. Thankfully, neither are directly exposed to Russia or Ukraine. However, there is some indirect exposure as both companies operate their businesses across Europe. Bank of Ireland stands to benefit from future rising rates, although the European Central Bank has indicated that those planned increases will be on hold for now. Materials businesses should fare well in the current environment, driven by sanctions on Russia. Russia exports a significant amount of raw materials like steel. They produce coal, natural gas, and oil for many of the European countries, and taking that Russian supply offline will raise prices globally. This will probably benefit the economics of our companies like Warrior Met Coal and GrafTech, both which support the steelmaking industry. And as Dominic will discuss later, we want to be owners of businesses with pricing power because they're able to adjust their businesses to accommodate a rising cost environment. Our energy positions fared best during the quarter, and we proactively exited positions in Devon Energy and in Tidewater. Both investments performed exceptionally during the quarter, and we chose to deploy that capital into other bargain-priced investments where we have intimate familiarity. It's likely that energy costs will remain elevated, although current stock prices seem to have adjusted for this expectation. Our exposure to commodities through our investment in Capstone Mining will also benefit from higher transport and production costs. So Capstone, they hedged their energy costs, mainly the price of diesel, back in 2020 at lower prices than we see in today's market. And this is helping Capstone Mining realize greater profit margins today. Also, the demand for copper and other precious metals is increasing as more and more drivers are switching to electric vehicles. And finally, consumer spending and travel will likely slow down somewhat as costs are increasing. Our exposure here is limited to the shopping mall REITs, Tanger and Kimco, and the travel-related businesses, Hersha Hospitality and Lowe's through their hotel ownership. These companies tied to consumer confidence and spending, we expect somewhat of a slowdown if energy and other household costs increase. And while our shopping mall and hotel investments might have some lower traffic, we're not overly concerned. These businesses are showing signs of improving economics, and we continue to feel confident in holding them. So overall, we do not feel compelled to change any of our holdings because of the war in Ukraine. The way we have your investments positioned during this period of uncertainty is probably going to create more opportunities for us. We view any drawdowns in the stock prices of our favorite businesses as opportunities to continue adding to these wonderful companies. I think it's important to mention that in Europe, it is a very different story. Over the last decade, European countries have focused their efforts on green energy and favored outsourcing fossil fuel production and converting to electric, solar, and wind energy. However, this massive shift in energy policy left Europe with national security exposure and serious economic risks. Europe collectively placed far too much trust in Russia, and this chart shows just how Europe's dependence on Russia has changed since the 1980s. As I mentioned on the last slide, our U.S. investments that operate in the oil, gas, and coal production stand to benefit as their products are now in greater demand in Europe and because prices are on the rise globally. But the unknown factor is how long Russian sanctions will last and what will happen to prices and distribution as Europe shifts its energy imports to more stable trade partners. This isn't to say that Americans are not feeling pressure, though. Similar to Europe's energy situation, the United States also outsourced a lot of our onshore production activities during recent decades. By relocating factories abroad, U.S. companies capitalized mainly on Asia's lower-cost labor force, along with their less stringent worker protections. And the result was more jobs for non-U.S. workers, economic growth for those countries where manufacturing was done, increased competitiveness for U.S. importers, and of course, bargain-priced goods for the American consumer. Because the U.S. outsourced much of our manufacturing to Asia, we have all enjoyed a substantially lower level of inflation for the past 30 to 40 years. This chart shows how inflation has steadily trended down since the early 1980s to 2020. But today, we're seeing these inflation figures rise rapidly. And one area where the U.S. shares a similar vulnerability to Europe is in the semiconductor space. You might call these computer chips. So consider that in 1990, the U.S. and Europe were responsible for over 80% of global semiconductor production. By 2020, that production share was only about 20%, and the demand for chips has continued to grow. Because of the pandemic shutdowns, the chip shortage left many industries with long lead times between when a semiconductor is ordered and when it is delivered. The chip shortage is making semiconductor companies very profitable today, but if we look at the downstream effects, we're seeing a very different story. So automakers, consumer electronics companies can't get products without these chips. They can't produce their products without these chips. So if we go back to Economics 101, when we see demand increasing and supply decreasing, the result has to be rising prices. And that's part of what is causing inflation in our economy right now. The similarities here between the US and between Europe and the US are that both economies have inadequate supply of essential goods and permitted themselves to become reliant on less than reliable trade partners. So there's vulnerability in Europe, which is causing Europe to scramble to figure out where their energy supply will come from. And the US is equally vulnerable from a national security and economic standpoint on Asia. In the quarterly newsletter that you'll receive sometime next week, I mentioned Howard Marks' memo called The Pendulum of International Affairs. I highly recommend you spend 15 minutes reading it. And if you're interested in what this is going to mean for the next decade, but I'll summarize it by saying that just like we spent recent decades moving towards outsourcing our essential products to obtain lower prices, it's likely that we'll start to see the pendulum swing in the other direction, where we take a more protected stance on producing essential products on U.S. soil to protect ourselves from unpredictable trade partnerships. And because of all this, our opinion is that we're really only in the early innings of a higher inflationary period in our nation's history. It's not in my power to predict how high inflation will go, but I am comfortable making the claim that higher inflation is here to stay for the foreseeable future. And these inflation pressures, combined with the fact that the labor market has improved dramatically since the pandemic unemployment spike in 2020, it's created a situation where our Federal Reserve needs to be more aggressive with interest rates. In their March meeting, the Fed signaled the intent to raise rates in each of the remaining 6 meetings in 2022. I have a chart up here that shows what those projections might be. The Fed is also going to present a plan to begin reducing their huge bond holdings. And both of these maneuvers would suggest that long-term interest rates should go up and likely will slow down spending in the economy. And so the logical question here is, will these monetary policies lead us into an economic recession? And from our vantage point, it's not necessary to make a timing call on when a recession will happen. It does seem reasonable that more aggressive monetary policies would lead us into a slowdown of the U.S. economy. I would only be guessing if I made a call on how severe that slowdown will be or how long it could last. The plan that we have consistently employed with your investments is designed to be an all-weather plan. Whether we have high inflation or low inflation, high interest rates or low interest rates, the effort is being made by our team to identify and buy ownership stakes in companies that can navigate in any economic environment. So Dominic is going to talk about how our portfolio is very different from the conventional advice that's provided to the retirement market now. And Dom will explain why this approach makes even more sense in the world that we live in today. Dominic?
Thanks, Justin. Your portfolios are constructed much differently compared to the traditional investment advisors. The model portfolio used over the past 30 plus years for retired individuals and for those with moderate to low risk tolerance has been the 60-40 portfolio, where 60% is invested in an equity portfolio, such as the S&P 500, and 40% is invested in bonds. The 60-40 portfolio rose to popularity throughout the 80s, generating good returns with lower volatility than the market. Typically, the 60-40 portfolio would decline less than an all-equity portfolio, as bonds historically hold their value better in market downturns because they are safer investments. The chart on the left presents the 5-year returns of the S&P 500, shown in light blue, the Bloomberg U.S. Aggregate Bond Index, shown in dark blue, and the 60/40 bond portfolio comprised of the two previously mentioned indexes in green. The way this chart works is the June of 1987 return shows the previous 5-year annual return for each portfolio. So from June 1982 to June of 1987, the 60/40 portfolio averaged roughly a 24% per year return. The market generated roughly a 30% return, and bonds generated around a 15% return per year. In 2000 and 2008, significant declines occurred in the S&P 500. The 60/40 portfolio declined less due to the bond portfolio holding its value. On the flip side, the portfolio fails to capture the entire upside of the S&P 500, most notably during the highest return periods for the market. So why did we not implement this type of portfolio at O'Keefe Stevens? Since 1986, bonds return profile has steadily declined. The reason for this is pretty simple. Interest rates, on average, have been on the decline since 1981. The 10-year Treasury had an interest rate of 15.84% at one point in 1981, which seems crazy given where we are today. When rates decline, the interest and coupons generated by bonds also declines, causing the return of the bond portfolio to decline. The 10-year Treasury stands around 2.68% today. A bond that once generated almost a 16% return is now generating a 2.68% return. The bar chart in the top right shows current holdings in one of the most popular bond ETFs used today, with over $85 billion in assets, the U.S. Aggregate Bond ETF. As shown, Treasuries make up almost 40% of the portfolio, and mortgage-backed securities represent 27%, both of which are AAA rated. A bond with a AAA rating is said to be risk-free and has a minuscule probability of defaulting. Risk-free investments generate very low returns since they are guaranteed to pay out. If all bonds in this portfolio were held to maturity, you would generate approximately a 3% return per year. This return profile simply does not work for many retirees, and for those trying to save up for retirement, a 3% return does not help them achieve their goals. On top of this, we have been talking about the inflation picture for the past several years. With inflation above 7% recently, your return after factoring in inflation is a negative 4%. The biggest fear in retirement is running out of money. Having expenses rise by 7% and only generating a 3% return is simply a recipe for disaster, and one of the primary reasons we employ an all-equity portfolio. Whereas your income stream is fixed with bonds, an equities portfolio stream can increase, offsetting the rise in expenses you are facing. If we were to use the expected return of the bond portfolio of 3% and the long-run 10% average return of the S&P 500, the expected return of the 60/40 portfolio going forward is roughly 7.2%. While not bad by any means, since 1987, the 60/40 portfolio has returned around 9.2% per year. Those utilizing historical returns of the 60/40 portfolio are likely to be disappointed by the future returns it generates due to the significant decline in rates. Instead of purchasing bonds with fixed payments, we choose to own businesses with the ability to increase dividend payments over time. Several of our companies have grown their dividends at double-digit rates over the past decade. In our opinion, the increased risk equities bear is more than offset by the increased earnings and dividends we benefit from. As we have stated before, we do not view risk as the volatility of a portfolio. Risk is the probability we lose money on an investment, and in retirement, the risk is running out of money. Instead of owning bonds with a fixed payment, we can own securities that have shown a good history of paying and increasing dividends. Franklin Resources is a company that has increased its dividend for 41 consecutive years. Couple that with our opinion that the stock is also undervalued. Qualcomm is one of our favorite positions and is one of the cheapest high-growth tech stocks we can find. The stock is trading around 16 times last year's earnings and is expected to grow earnings by around 40% this year. We are getting earnings growth, dividend increases, and purchasing the stock at a below-market multiple. It's not even a question of whether we should own an undervalued stock with a 2% dividend yield over a bond that may yield 3 to 4%. What seems like a better option? Owning bonds that guarantee your purchasing power will decrease over time, or a portfolio of securities with a history of paying and increasing their dividends? To us, the answer is obvious. When inflation is at decade highs, our portfolio gives you the ability to maintain and improve the purchasing power of your retirement income. Next, I'll talk about the concept of research and development, or R&D for short. Technology advancements continue to occur at accelerating rates. For companies to remain relevant, they must continually invest in product advancements. Companies that tend to spend on research and development are more likely to stay ahead of the competition, allowing them to maintain and grow market share. Research and development expenses are costs relating to a company's efforts to develop, design, and enhance its products, services, technologies, or processes. In 2021, almost $1.4 trillion was spent on research and development globally. Shown in the top chart, technology and healthcare stocks or companies spend the most on R&D by a wide margin, consistent with what we've seen in our portfolio holdings. We like investing in companies that spend on product advancements. It gives us confidence in the management team's vision, as the reward for spending on R&D does not benefit the company for several years. We like to align ourselves with forward-thinking companies, ones that look at the big picture 5 to 10 years down the road, not one that's worried about making next quarter's Wall Street numbers. R&D expenses hit the income statement in the year they occur. However, revenues generated from spending do not come to fruition until years down the line when the product hits the market. One company this is especially true for is Amgen. Amgen is a biotech pioneer founded in 1980. Amgen discovers, develops, manufactures, and delivers innovative human therapeutics. In 2012, Amgen spent $3.5 billion on R&D, and in 2021, they spent $6.3 billion. Drugs take years on the short end to decades on the long end to develop. Amgen currently has 21 drugs in phase 1, 14 in phase 2, and 19 in phase 3. Drug patents last for 20 years. After that, generic drugs are typically created, invoking immediate competition and lowering the revenues of the previously patented drug. Amgen must continue to innovate to grow revenues, as several drugs come off patent every year, presenting a headwind to revenue growth. By continually investing in R&D, they can maintain a robust pipeline and a roadmap to deliver increased revenues, earnings, and dividends over the coming decade, as they recently laid out. Corning is another company that continues to be on the cutting edge of innovation. Founded in 1851, Corning has had a long history of R&D success. In 1972, they developed a cellular ceramic substrate for catalytic converters to reduce vehicle emissions. Today, ceramic-based mobile emission controls, like products developed by Corning, help save as many as 160,000 lives each year. They also help prevent just as many cases of heart disease and asthma cases as well. And from the time catalytic converters became mainstream in 1975 through today, light and heavy-duty vehicle emissions have dropped by an astounding 99%. In 1982, Corning developed LCD glass, a thin, flat, and stable glass suitable for TVs and computers. In 2007, one of Corning's most well-known products, the Gorilla Glass, allows us clumsy individuals to drop our phones and not have a shattered screen. Also in 2007, they developed a fiber that can bend 90 degrees while experiencing minimal signal loss. Finally, in 2017, Corning developed Valor Glass, reducing particle contamination, breaks, and cracks in the pharmaceutical glass packaging. I could go on and on about the exciting opportunities companies like NVIDIA and Qualcomm have in the mobile, PC, gaming, Internet of Things, and Metaverse, but I'll save that for another day, and I'll hand the call over to Pete.
Thanks, Dominic. One question that keeps coming up that I wanted to answer today is, why do we continue to own investments that have been showing a loss in my account for many years? Why not sell these losers and move on by adding to my winners? These are great questions that we're often asked in review meetings. The quick answer is because we see tremendous value in the investment, and a declining price in the investment makes it an even better value. And assuming that our original investment thesis is still valid, it makes sense not to sell, but to add to our original position. One of the most common questions we're asked today is what's wrong with Fannie Mae, and should we continue to own these investments? Federal National Mortgage Association, also known as Fannie Mae, ensures the availability of the 30-year fixed-rate mortgage by guaranteeing investors should homeowners default. Fannie Mae securities have been in conservatorship since September 7th of 2008, with no immediate end date in sight. In addition, the U.S. Treasury has not agreed that the $120 billion of loans and fees have been repaid, even after recovering $181 billion of reimbursement payments and owning warrants to control approximately 80% of the company. The Supreme Court last June refused to overturn the so-called net worth sweep, which had been requiring Fannie Mae to forward all profits to the U.S. Treasury. However, the Treasury amended its agreement in early 2020 to allow Fannie Mae to retain earnings necessary to build capital and to ensure safety and soundness of the business. The net worth of Fannie Mae ended the year 2021 at over $47 billion, up from approximately $25 billion at the end of 2020. After reviewing Fannie Mae's financial performance for the year, I believe it to be one of the most undervalued opportunities of my career. For the year 2021, Fannie Mae had revenues of $30 billion and net income of $22 billion. The $22 billion of net income is greater than the combined profits of Corning, NVIDIA, and Qualcomm. However, the value of all Fannie Mae common and preferred stocks is 100 times less than the combined market value of these three companies. Fannie Mae's common is valued at approximately $4 billion, its preferred stock at approximately $2 billion, while Corning, NVIDIA, and Qualcomm are valued at over $800 billion. I have no idea when the conservatorship will end. I'm willing to take an extremely long-term view that it will be resolved. I'm confident that our investment in this period of extreme uncertainty will be well rewarded. By almost every value metric, Fannie Mae is trading at ridiculously low valuations, whether it be price to revenues, price to earnings, or price to book value. Many would counter that our investment thesis by stating that major lawsuits and political headwinds stand in our way with no immediate signs of resolution. While this may be true, I would also remind them that the lawsuits were instrumental in the success of some of our largest positions. It was Qualcomm's settlement with Ericsson in the year 2000 and NVIDIA's settlement with Intel in 2009 that were partially responsible for the great successes each of these businesses have enjoyed in subsequent years. Given our views, we've been adding to our position in both Fannie Mae common and preferred. Carly?
Thanks, Pete. All right, now we're going to move into the question and answer portion of the call. Please submit any questions you may have in the question box or the chat box, and we will take a look at them and answer them. Thanks. All right, it doesn't look like we have any questions yet, so if you do have one, we'll stay on for a couple more minutes and just type it into the question box or chat box, please. Thanks. All right, we did receive a question, and this is about tax harvesting. So Justin's going to answer this for us. Would tax harvesting be a strategy you would think about? Sell losing stocks and buy back in the same price to reduce basis and have a loss to write off?
Good question, and this is definitely a financial planning subject that we review every single year. Generally speaking, we look for tax loss harvesting at the end of the year, but you could do it anytime during the year, and I'll just quickly explain what that process is. A tax loss can be taken when you sell an investment at a loss. If you wait 30 days beyond the day that you sell it and then go buy it back, you can take that loss as a loss against any capital gains in your portfolio, or up to $3,000 of that loss can be applied against your income in that tax year. So in years, to answer your question, in years, if we happen to have a significant capital gain from the sale or purchase of a investment that was in our portfolio, like this, earlier this year, we had a TK LNG purchased from us and it created some capital gain. If we wanted to minimize those gains, we could definitely look for an opportunity to sell a position in the portfolio that was at a loss to help offset any tax implication from those gains. It's important to remember, probably 60% of the money that we manage in our portfolio across all client accounts is in retirement accounts. So they're either tax deferred accounts or Roth tax exempt accounts. And so we don't do any tax loss harvesting in those types of accounts. It's unnecessary. But for any taxable, individual accounts, joint accounts, trusts, we do look for opportunities to tax loss harvest, but we tend to only do that when there's a glaring capital gain that we're trying to offset. We're not too keen on just selling for the sake of tax efficiency, because as Dominic and Peter, I'm sure would chime in here. We want to hold many of these investments for the long haul, and even being out of them for 30 days sometimes, leaves us vulnerable to variances in the market and the price of those securities that we would otherwise not be comfortable taking. So good question. Stay tuned for that later in the year. We'll keep you posted if we end up employing any tax loss harvesting strategies.
Okay, we did get another question. This is, what are your thoughts on Hersha Hospitality?
Dom, do you want to take that one? Or Peter, either one?
Sure, this is Peter. Hersha Hospitality is an owner of 35 upscale hotels. Like many in the hospitality industry, both hotels and restaurants, COVID-19, they had mandatory shutdown of those hotels. And so they were put into a very vulnerable position at that point in time. Hersha Hospitality was very proactive in how they managed that by immediately tapping into their lines of credit, reducing salaries of top management, and cutting costs dramatically in their hotels. They had also invested very heavily in upgrading several of their hotels. They have an ongoing cycle for doing that. And in addition to that, they had been hit by some hurricanes in South Florida that caused significant damage, but most of that was recovered through insurance payments. Hersha Hospitality now has their entire portfolio opened up, although to strengthen the company and their balance sheet, they did sell off some of their non-core hotels, and that helped improve the balance sheet. And the Hersha is also has heavy insider ownership, so our ownership is highly aligned with theirs, and that we do not see the likely decline of our ownership by issuing additional stock in the business. So we're happy with Hersha Hospitality, but it's going to take several years for that investment to recover. But in past years where they've had issues, like for example, with the 9/11 attacks, that hurt the hospitality industry, and the history has shown a really significant and oversized returns as individuals came back and became more comfortable with travel and staying in hotels. Dominic, anything you wanted to add?
Yeah, I'll just chime in real quick. It's going to be a really interesting company to watch over the next year. There's been a lot of pent-up demand in travel, and we have seen a few of their hotels actually have occupancy rates and rate per room that they're charging higher than it was in 2019. So as we move into the summer years when travel is expected to pick up, the main thing we, I guess, just have to be cognizant of is higher oil prices typically leads to higher travel expenses, whether you're flying or driving. So are the increased costs on that side going to, I guess, restrict some individuals from traveling, or is just a pent-up demand from the past 2 years where people haven't been able to get out of the house? Is that going to outweigh the factor and allow them to stay at these hotels? So I would say I echo Pete's sentiment in that we're very optimistic going forward, and we'll just have to see how things play out over the next couple of years.
All right, we do have another question. It states, will the war in Ukraine and current reliance on foreign oil drive increase in government funding for renewable energy businesses? And if so, how will that affect OSA's position?
Okay, you want to start?
Sure, I'll try and start. Yeah, it is. We currently do not have the infrastructure to make a big leap every year in the renewables business. We have not, as a country and pretty much globally, have not invested in copper, which is going to be one of the main raw materials used to make the EV transition. So I would just say, even if there is increased spending, it's kind of interesting because on the one side you've got the green EV movement, and then on the other side people view copper as more of like a dirty industry, but it's a necessity to make that investment. So just on how it would impact our portfolio, in general, clients have a position in Capstone Copper that recently merged with Mantos Mining. That will experience significant benefits if they continue to invest in green energy. GrafTech is another one that we have talked about in the past. Steelmakers switching from blast oxygen furnaces to electric arc furnaces are much cleaner in terms of pollution. So again, we would benefit there. The main way we would, I guess, face a headwind is just in anything that benefits from higher oil prices. If you take off a lot of demand for energy, obviously the price on that side would go down. But as Justin talked about, we trimmed some of the positions there. In the end, I think it would maybe be a net positive for us, but I don't think it's going to be that big of a factor in our portfolio.
Yeah, and I'm just going to chime in one more thing. I was pulling up a great resource that we watched maybe a couple of months ago, and I will send this video out to you, the person who asked the question. Arnold Vandenberg talked about this energy transition and the quest to eliminate CO2 and really just some of the structural problems that exist. Even governments have been way too lofty in terms of their projections about what can happen. It took centuries to build the energy infrastructure that we have today, and it's being estimated that we're going to be able to rebuild this in the next 2 decades. But that transition is just going to require an enormous demand for commodities, something that we don't even come close to producing those amounts of raw materials today. So I will send over that presentation. It's about an hour and a half long, but if you watch just the 15 minutes or so on the energy transition, I think it'll help frame a lot of the perspective that we have on what's going to happen. I do think that we're going to see massive energy transition over the next 2 decades, but I don't think that will supplant the traditional fossil fuel business that we have today. I think it's great for the environment, and all these things are very, very lofty goals that we should strive to achieve. But the fact of the matter is, we can't flip a switch overnight and have that transition happen.
All right, and we have another question. Is your confidence in Fannie Mae strong enough to consider adding to the position in the portfolio? Peter or Don?
Let Peter go first.
Absolutely, and we have been adding to it as we're reviewing client portfolios this month, and we'll be continuing to review portfolios for the next throughout this whole quarter, and in good chance we'll be adding to Fannie Mae, but we're also adding to many of our other positions that we have a high conviction with as well. Dominic, anything you want to add?
No, just that we would, Pete and I do a top 10, like our top 10 favorite holdings every month, and Fannie Mae continues to rank up at the top every month. So our confidence remains there, just given the discount we see between the price that we can pay today and the potential value whenever the ruling goes in our favor.
All right, and we have another question. What is your position on investing in crypto? Peter or Don?
Sure, I can start. I wrote a piece on it a few letters ago, and we do not invest in something like that. We prefer to invest in businesses that have cash flows, and one where we can actually value it. So if the business's value is its future cash flows it can generate, Bitcoin, we wouldn't have a clue on how to value something that never will produce a cash flow in the history of its existence. So it's not something I would ever expect to enter into your portfolio. At best, we think it's a speculation, and again, just not something comfortable we're going to add to your portfolios.
And I'll add one more thing. When regarding speculation, when the speculators headed west looking for gold, the business to be in was selling pickaxes and shovels, and we feel very strongly that the pickaxe and shovel business, when it comes to cryptocurrency, is in the semiconductor space, specifically with our investment in NVIDIA. So we own the dominant company that exists out there today that mines cryptocurrency through the use of its graphic processing units. And so, our exposure to that market is strong, and it's related to something that we can measure and gauge, with consistent, reliable metrics. And it's not the speculative side of the business, it's the fundamental side of the business that we're interested in. Peter, do you have anything?
I do. We've spent years developing an investment process that we follow closely. And one of the major scenarios that we want to always be is responsible stewards of your wealth. I can't even begin to imagine me having a conversation with you or anyone else of me entering into a speculation such as cryptocurrency and having no clue as to why I'm investing in that, but I chose to invest in it because it seems to be a fairly popular thing. So it's just not something that, yes, there's folks who have been making money in that, but as a responsible steward of your wealth, I think I would be totally irresponsible to be investing in crypto securities. And I don't care how many commercials are on television, I can't invest in something that I can't value.
All right. I think that ends our question and answer session for today. So thank you for joining us today. And again, our call will be recorded and available on our website beginning tomorrow.